Hello and welcome to my channel, The Quality Investor. This is part 2 of my dividend investing strategy series. In part 1, I discussed owning a portfolio of just dividend aristocrats. My conclusion to that was that it was a less than optimal strategy if you're looking for both growth and dividend safety. I demonstrated on that video that inflation ate in to dividend growth that was less than 5%, as well as returning less than a standard S&P 500 index. And this is primarily due to the slow growing nature of dividend aristocrats. Today, I want to focus on the other two types of dividend investing. This is high yield dividend investing and dividend growth investing. To be clear, I'm discussing this in the context of picking your own stocks. There are a lot of high yielding dividend ETFs and mutual funds out there, but this is not under consideration on this channel. Before diving in though, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. When looking at these two strategies, each of them have their advantages and disadvantages. So let's start with high yield dividend investing. On The Quality Investor, I advocate for buying high quality compounding businesses and holding those for the long term. So when I see dividend yields creeping above 4% or so, for me, the caution flag starts waving. The reason for this is that there's an inverse relationship between the share price and dividend yield, meaning when the share price is declining, the dividend yield is going up. Therefore, when high yields are persisting over time, that means our capital is not appreciating. So I want to show why I believe high yield dividend stocks are actually value traps. However, let's start with the positives first. The first advantage is high income. You see, a 5% yield on $1,000, that's $50, and that's annually, of course. So it's like an interest rate on a high yield money market or savings account. Secondly, dividend increases push the yield on cost even higher. So if you buy a stock for $1,000 and it's paying that 5% yield, every dividend increase thereafter, it's going to push that yield a little bit higher. So you're going to have a higher yield on your initial capital investment, every single dividend increase. Thirdly, high yield dividend stocks are great in low interest rate environments. So as the Fed kept interest rates very low throughout the 2010s, it was a very good alternative to a money market or savings account. And finally, it's better for retirees that prioritize income. They get that higher yield, they have more income, and there is maybe a little bit more capital safety, but as we'll see in a second, maybe not. The first is share price decline. See, the reason we have a high yield in the first place is because that share price has come down over time. This is an indicator the business might be in trouble, and it could also signal for a low quality business. And this is really not for the quality investor. Secondly, dividend raises average under 6.5% annually. And you see that once it starts getting above that 4% yield. Really, that makes it a bad hedge against inflation, which we've seen the last couple of years. Conservative estimates are about 5%. A third disadvantage is lack of dividend safety. As we talked about, a business might be in trouble when they have a high yielding dividend, and that might lead to a dividend cut. We've seen businesses in the last couple of years, especially ones that were already a dividend aristocrats, cutting their dividend. Walgreens, AT&T, Disney cut its dividend. That shows that these businesses are desperate for cash and they have to hold back that dividend in order to have cash to pay basic operating expenses. You can see signs of that through a high free cash flow payout percentage. And the last disadvantage I want to talk about is it could hurt future growth. You see higher dividends, that means less money is being reinvested back into the business. You need to reinvest money back into the business to spur growth in the future. And because they're not reinvesting back into the business, there could be some downside risk in the future for this business, especially in the share price area, because they're relying on their current operations that are already proving not to be as competitive in the market. Okay, so let's demonstrate visually some of these high yielders and what that means. So I'm looking at companies that are yielding above a 4% on their dividend yield, and they're in the S&P 500. So starting with the top chart, it's the 10-year compound annual growth rate of the dividend yield percentage versus the 10-year share price return. Now, this isn't like a predictive chart here. I'm just demonstrating the relationship between dividend yield growth and share price return. So this yellow line, this is the average S&P 500 10-year return at 10.16%, last 10 years compounded annually. And look at all of these 4% or more yielding stocks. None of them returned the average S&P 500. This top right quadrant of this chart here, this is where you want to be if you are going to invest in high yield dividend stocks. This shows a dividend yield increased and the share price increased. You can see UPS here as an example. Their dividend yield over the last 10 years increased by about 1.25% per year, while also getting about a 4.6% increase per year in share price return. Another example, of course, is Philip Morris. The bottom left quadrant of this chart, this is the danger zone for high yield investing. This is where not only are you getting less dividend yield over time, you're also losing in share price appreciation. A good example is AT&T. Their dividend yield shrank and they lost 4% per year for investors. There's some other big names in this area too. You have Bristol Myers Squibb, you have Pfizer. The bottom right quadrant is also not a good place to be. You did get better dividend yield increase over time. However, you did lose quite a bit in share price appreciation. To me, the bottom half of this chart, this shows companies that are in trouble and that high yield is really a trap. A couple other things I want to point out here. You see this free cash flow payout percent rank here. These are the companies, the top 15 companies with the lowest free cash flow payout percentage of the high yielding dividends. You can see, note what these percentages are. The lowest one is 17.7%. And then the 15th ranked best one is over a 50% free cash flow payout. Also, this is the dividend growth over the last 10 years per year. So your 10-year compound annual growth rate for dividends. Citigroup, of course, 48%. That's not bad at all. But you can see this is all of these 4% or higher dividends averaged together. That's 6.4% when you take all of these together, average compound growth rate for their dividends. And you can see it, there's a lot that fall below that 5% threshold here. You know, you're coming down, Bristol Myers Squibb, Sealed Air, Philip Morris. These dividend increases, they're not keeping pace with inflation. The last strategy I want to discuss is investing in dividend growth stocks. The most notable feature of these stocks is their low yields. I view low yield stocks as less than a 3% yield for their dividends. And for me, this is where the best high quality compounding businesses are found. To be clear, not every business that's high quality will yield less than 3%. But the reason a lot of these businesses are yielding this low is because they're growing so much faster than the average business. This is truly the compounders. So while dividend growth is the sweet spot for both capital appreciation and dividend income, let's talk about some of the drawbacks to dividend growth investing. The first disadvantage is the low yield. So on a $1,000 investment, a 1% yield, that means you're only getting $10 per year in income. And that brings us to the second disadvantage. It requires a very high amount of capital up front to generate high income. So if you want to rely on dividend income to meet your daily expenses, you need to have a high starting amount of capital to even consider that as an option. All right, let's talk about some advantages of growth dividend investing. The first advantage is the dividend increases average above 10% per year. This makes it a very good hedge against inflation. It also means that if you're using a drip program, meaning you're reinvesting your dividends every time you get them back into that stock, you're going to really accelerate that compounding effect. And we all know the magic in investing is the compounding. The second advantage is it's a very safe dividend. There's a very low free cash flow payout percentage. So there's a lot of room for growth for that dividend. Companies can increase that dividend at a higher rate faster because they have a lot of room with their free cash flow payments to generate more growth. Thirdly, this is an indicator of healthier financials for a business. Remember, to get a low yield, that share price has to increase so much faster than what the dividend's increasing. And that just is an indicator of a strong and stable business. It also, in my view, means there's a lot lower of a downside risk because you're investing into a company that has demonstrated it has a high competitive advantage in the market. And finally, the last advantage I want to talk about is the future growth potential of that business. So with such a low payout for dividends, that means there's a lot more capital to reinvest in the business, to find new opportunities and new projects that generate higher returns on capital. This is a very necessary ingredient for compounding. All right, so we're looking at that same chart again, and you can see here a stark difference between the high yielding chart. So anything above this yellow line, that means they returned a better average than what the market has over the last 10 years. And in this top right quadrant, this is the superstars of dividend growth investing. Broadcom, for example, they have increased their dividend yield while at the same time increasing their share price over the last 10 years by a whopping 36%. So identifying businesses in this top right quadrant, that really will increase not only your share return, but your yield on cost a lot faster than normal investments. In this top left quadrant, these are really fast share price appreciators. You have your Microsoft here. Their dividend yield has fallen 11% per year, while their share price has increased 27% per year. And of course, the major superstar in the market right now, Nvidia, who has seen their dividend yield fall 18% per year over the last 10 years, while their share price has just returned an incredible 65% per year. And to me, there's other major differences. Remember that free cash flow payout percent rank here? Well, look at the lowest free cash flow payouts, the 15 lowest. All of them are under 7% free cash flow payout percentage. This shows the extraordinary capacity to increase dividends over time because they're not using all that free cash flow to pay a dividend. And this last chart here is showing that dividend growth, the 10-year compound annual growth rate for dividends, and you can see that they compound so much faster than the high yielding dividends. You're averaging for all these low yielding dividend growth stocks over 10% annual growth for a dividend. So very good long-term opportunities in the low yielding dividend growth investing segment. Hopefully, this illustrates the difference between dividend investing for yield and dividend investing for growth. So while yields are lower initially for dividend growth stocks and you need a lot more capital up front to get a higher income, to me, it's a much more optimal strategy for both capital appreciation and dividend growth over the long term. The highest quality businesses out there, they are found in those low yielding dividend stocks section. And the essence of this channel is quality investing. This wraps up part 2 of my series on dividend investment strategy. So as a reminder, this is not financial advice. And as always, I encourage your own research. With that, thank you for watching today's video. And what do you think? What type of dividend stocks do you like to own? Please let me know in the comments below. Also, please like and share this video. And if you found this content useful, consider subscribing to the channel and joining our community. Thank you and happy investing.